Good afternoon, everyone. As you all know, the title of the presentation is Profiting from Megatrends and Historical Patterns. Um, I believe that the best way to start the presentation is to define what a megatrend is. So we go now to the part of the megatrends, and it's basically a definition by way of contrast. So most of you are probably aware already about technical analysis, which is supposed to analyze short-term trends. So it can be daily, can be weekly, monthly, and some even analyze technical trends on a minute-by-minute or 5-minute charts. On the other end of the spectrum are what we call megatrends. And the picture that you see on the left shows windmills. And one of the main things that we are experiencing today is climate change, of course. And that is an example of a megatrend that will affect our lives over a long period of time. So megatrends are global, sustained, and macroeconomic forces of development that impact business, economy, and society. They define our personal lives, they define our future personal lives over a period of 10, 20, 30, or even more years. So our next slide shows the first example of long-term trend, and that is digitalization. If you have seen the movie Ready Player One, then you know that it is a future society. It is set in a future society where people are mostly online. They are online most of the time. And as you can see in that photo there, everyone is on their VR headsets. I don't think that the world is anywhere near to that. And I don't even think that it will happen in the future. I mean, I don't think that anyone wants to spend most of their time online all the time. However, there is no denying the fact that there is a change, an ongoing change in consumer behavior toward online experiences. So the pandemic has accelerated and reinforced this trend towards online. So more of us are banking online, our children are studying online, we're no longer going to the movies, we enjoy Netflix. A lot of us are working from home, we're doing our shopping online. So this trend is definitely going to benefit a lot of companies, among them telcos, logistics companies, because of all those deliveries. And one of the companies that we've recently highlighted is Cirtec, because Cirtec is supplying base stations and antennas to US companies that are rolling out their 5G networks. The next mega trend that I'd like to talk about is the trend towards renewable energy and electric vehicles. As I mentioned at the start, we're experiencing climate change, and one of the ways that the world is trying to address this is to boost the production of renewable energy. And in the past decade, there has been a lot of success. Solar and wind energy is now much cheaper than coal in some countries. You can see there that there has been a drop in costs of solar electricity by a factor of 5 in just the last 10 years. People have also been talking about the topic or the term peak oil for some time. But a few months ago, the CEO of Exxon himself said that peak oil might actually have already passed. So the trend is very strong right now. and we expect it to take hold even more in the future. And one of the ways that investors are taking advantage of this or positioning themselves for it is through ESG investing. And this is a way for fund managers to invest in companies that are ethically responsible. They take care of their social responsibilities and they put an emphasis on governance. So what this is doing is putting pressure on fossil fuel related stocks, coal companies, companies that produce electricity using coal. So that is again something that will affect stock prices for these types of companies for a long time. Still on renewable energy and electric vehicles, a few weeks ago or 2 weeks ago, China announced to much fanfare that it is pledging to become carbon neutral by the year 2060. That is 40 years from now, and that seems like a very long time. But if you think about it, there's so much that needs to be done between now and then for China to be able to achieve that promise. They have to shut down a lot of coal plants. They have to build up a lot more, much more solar farms and wind power projects. And that is going to, that has affected, that has already affected the outlook for solar companies. And that has already affected the price of coal and the outlook for coal-related companies. On the other hand, several countries have already announced proposals to ban fossil fuel powered vehicles. For example, Norway is the earliest. They are planning to ban internal combustion engines or ICE vehicles by 2025. By 2030, the Netherlands, Israel, Ireland, India, Germany are going to follow suit. China, the biggest car market, is studying the ban. They've already announced that they're going to ban, but they're still studying as to when they will do it. And they might announce a target this coming January. So as we all know, or as many of you probably know, the key component for electric vehicles is the battery. And the more electric vehicles there are, then the potential demand for nickel is going to be much higher. So this is potentially going to be positive for nickel miners. And it's also potentially positive for IMI because a large bulk of its revenue stream is related to the auto industry. Now, the next slide. This is about demographic change. And this is the ultimate megatrend that affects all of our lives. It affects all aspects of our lives, business, and even politics. Demographic change refers to the changes in the age structure of a given population. The chart on your right shows the age pyramid or the age and sex structure of Japan. As you can see there, it is widest in the middle. And that is because the median age for Japan is about 47 years old. So it's widest at the middle. It is also quite wide near the top, near the 70 to 74-year-old range. When you go down to the bottom of that pyramid, it becomes narrower and narrower. And the fact is that there are more 70 to 74-year-olds today in Japan than there are babies. And what this has done is that there is actually a larger market for adult diapers in Japan compared to the market for baby diapers. And that's the reason why I put the drawing there, the comic there, where the mother and the child are looking for baby diapers, but they can't find any. All that they see are adult diapers. Um, so that's happening to Japan, but it's not confined to Japan. Japanization, as the term was made up, is already being used to describe other nations. A few or a handful of Asian and European countries are experiencing population decline already. And when that happens, government and personal spending priorities change dramatically. So instead of spending for frivolous things, they tend to think more of saving for future medical expenses. And as you can see in the chart, it shows the change in the working age population for some countries. So from the year 2000, for example, from the year 2000 to the year 2050, Japan is expected to experience a nearly 40% decline in their working age population. For Korea and Italy, it's closer to about 20% decline in the working age population. And for Germany, it's about 15%. So this brings about the problem of whether or not there will be enough workers for these countries in the future. And that's why um, a lot of other nationalities are migrating to Europe. So the problem for Japan is that it's a relatively closed economy. They don't accept too many migrant workers. So that's why they're having a hard time right now. And that's why their economy has been relatively stagnant for some time. So why is the world's population aging? Well, one of the reasons is fertility rates. As you can see in the chart, fertility rates have been falling dramatically over the past 6 to 7 decades. And in Europe and in many parts of Asia, for example, the fertility rate is below 2. Um, the natural rate, the natural fertility rate for the population to remain constant is 2.1. So when the fertility rate of a country or entire continent is below 2, then that really means that in the future you should expect that populations are going to decline. The reason for the declining fertility are manifold. Just to give you an example, urbanization and higher cost of living is forcing married couples, to have fewer children. On the other hand, medical advances have improved the quality of life and lengthened the average lifespan for the global population. Uh, so fewer babies are being born, and then people are getting much older. Lifespans are getting longer, and that's why the global population is aging. Now, what this has done is that some countries like Japan, South Korea, and Singapore are now urging people to have more children, but they have not had success in the past decade or so. Still on demographic change, the experience of the Philippines is much more different. As you can see in the chart there, the age-sex structure of the Philippines is very wide at the bottom and very narrow at the top. And this is what demographic analysts would say is a healthy age pyramid, because there are more young people, there are more young workers that are willing, that are able to support the elderly in the population. In contrast, see there on the upper right, you see the age pyramid for South Korea. It's very top heavy. China, because of its one-child policy for several decades, is also going toward the way of South Korea. Again, as I said earlier, the problem with an aging population is that spending priorities for both individuals and the government change, and it becomes it becomes what we call an unhealthy age pyramid structure because of that. So, however, an age structure like this is not automatically positive for a country like the Philippines. We still have to have the right policies in place to take advantage of this demographic window. Again, just to expound a little bit more, this chart shows the dark green line shows that the number of people in the labor force has about doubled from 1988 to 2018. What this has done is that the age dependency ratio has declined significantly. So, for example, in 1988, 5 people in the labor force would support about 4 dependents. These dependents are either your children or your grandparents. By 2019, the ratio has shifted significantly. The ratio is now almost 2:1. 2 workers will support 1 dependent. Or at least it's almost to that level. So what this does is that people in the labor force, those who earn through their labor, can spend more for their wants rather than just for their needs. So this will improve discretionary spending significantly over time. The last slide on the demographic window, and this is why we like companies like Vehicl, for example. This chart shows the cumulative population growth for the Philippines from the start of 1990 to 2018. As you can see there, the population of the Philippines has increased about 80% from 1990 or 1989. But in the same period, the number of households has increased by 135%. So this is a function of a maturing population and higher spending power. When these two things happen, couples or those who are married tend to strike out on their own more frequently. So they have more money. They feel that they want to separate themselves from their in-laws or from their parents. So they go and buy houses for themselves. They go and build houses for themselves. So what this shows is that household formation is growing much faster than the population itself. And this is very beneficial for home improvement companies like Vehicl. And that's why Vehicl has been one of our top picks since it listed in 2017. Now going on to the second part of our presentation, which is about historical patterns. So what are historical patterns? Historical patterns is part of a broader topic, a broader area called market anomalies. And in financial markets, anomalies refer to situations where a security or a group of securities performs contrary to the notion of efficient markets. I think you know the term that everything is in the price. However, in a lot of markets, especially for underdeveloped markets like the Philippines, markets are simply not that efficient. So there is a lot of opportunity to take advantage of market anomalies like historical patterns. And the first historical pattern that I'd like to talk about is ABS-CBN and how its stock price reacted to elections in the past. So as you can see there, the long-term chart looks like a roller coaster. That doesn't seem strange compared to other companies in the stock market, stocks really do go up and down. But as you can probably notice, the peaks usually coincide with the periods just before or during the elections since about 2000, since 2004, 2003, sorry, 2004. So in the past decade or so, the price of ABS-CBN would reliably move up prior to each of those elections in anticipation of increased political ad spending on the network. However, obviously, without a franchise anymore, this is not a factor that we consider. And it may be a while before we see ABS-CBN pick up again. The next historical pattern that I'd like to talk about is the adage, sell in May and walk away. Now, the roots of this adage is related to a different market. It's related to the US market in particular because in May and June, for example, school is out and it's summer there, and a lot of people go on vacations usually during the summer. And before the advent, for example, of electronic trading, the traders on Wall Street would usually close their positions because they don't want to worry about trading when they are on vacation. So they usually sell in May and then walk away. So we just tried to see if the same adage applies to the Philippines. In the Philippines, May and June is usually the start of the rainy season. So the adage shouldn't apply. However, when we looked at the numbers, the chart there shows that the average gain from December to May is much better compared to the average gain in the months from June to November. And the average return from June to November is actually negative 1.3%. However, as mentioned earlier, this is not investment advice. There's really a lot of volatility in terms of month-to-month returns for the stock market. And this really should not be taken to mean that you should get out of the market in May and then just come back in November. And you should also take note that this applies to portfolios rather than individual stocks. The next topic that I want to talk about is a strategy that we call dogs of the PSEI. I tweeted about this about a week ago, and I said that this strategy has outperformed the index in the past decade or so. So the first chart that I want to show you is the dogs of the PSEI 2019. The dogs that we refer to are the 10 worst performing index stocks at the end of each year. So in 2019, the worst performers for the index are the names that you see there: DMC, LTG, Jollibee, and so forth. So the strategy calls for investing equal amounts in the 10 worst performing index stocks at the end of each year. And you see the returns there in 2019 for these names. And then you see the returns for these names for 2020 year to date. Now, the returns for most of the names there are still negative, but the group as a whole has outperformed the index by 12 percentage points on a year-to-date basis. And the thing with this strategy is that it's mechanical. You don't need to think about it. There's really no deep analysis, and there are no extraneous variables considered. So in a way, it's a relatively easy trading strategy. Now, we backtested the data up to 1997. So from 1997, we took we noted the 10 worst performing stocks for each year starting in 1997. And as you can see in the chart there, the dog strategy has beat or matched the performance of the PSEI approximately 87% of the time. Now, in the past 12 years, the performance has been even more consistent. The strategy has beat or matched the PSEI in each of the past 12 years. And that is a very significant period of time already. I just want to focus on the box, the area there that I put the box in. So this blows up the picture to show up that box from the previous slide. So in the last 11 years, I just wanted to focus on the last 11 years to remove the huge outlier in 2009. So in the past 11 years, the cumulative outperformance of the dogs of the PSEI is about 108 percentage points. And I don't know of any strategy that has consistently done as well over such a long period of time. The next historical pattern refers to the elections. About a week or so ago, I think you may have seen the Pulse Asia survey, which showed the presidential contenders for 2022. This is despite the fact that elections are still about 19 to 20 months away. Nevertheless, we've actually crunched the numbers already. And what it shows is that despite the uncertainty surrounding the run-up to the elections, during the pre-election window, the PSEI actually has performed relatively well. In the past 5 presidential elections, the average return during the pre-election window is about 21%. And if not for the Asian financial crisis of 1997, the average returns would have been even better. Now let's look at the performance of the PSEI during the election season itself, and then on the post-election PSEI performance. By the way, we defined election season as starting from December up to the day of the election itself. And then the pre-election window is 1 year before that. And the post-election is the honeymoon period post-election. So the election season, everyone knows election season brings about increased government and private spending. And then post-election optimism is usually there. The honeymoon period applies. And it applies to all presidents, regardless of whether the electoral victory was by majority or by plurality. So as you can see in the chart, during the election season, the 6-month election season, the average return is about 12%. And the post-election performance is double that. The average return over the past 5 presidential elections is almost 25%. Now, when you put everything together, we tabulated the results. And you can see there the cumulative performance of the pre-election, election, and post-election returns for the PSEI for the past 5 elections. And the average return for the election window, as we call it, is a huge number, positive 72%. Now, if this historical pattern holds, then we believe that the PSEI will be at around 10,200 to 10,300 by May 2023. Of course, a lot of things can happen. There's there's a lot of uncertainty over a significant period of time. And 2.5 years is almost a lifetime for a day for those who are doing day trading. And a lot of issues can crop up. The Philippines is currently seeing a decline in new COVID cases, but there's no certainty that we won't see a second wave. Other things may show up, but on the other hand, we are also expecting positive news on a vaccine, hopefully as soon as at the end of the year, and certainly by the first half of next year. So we believe that there's a strong chance that this historical pattern will hold in the upcoming election season. So just to summarize everything, first of all, I want to emphasize that emphasize the caveat that past performance is not indicative of future results. So we talked about historical patterns and how they have affected share prices over the past few decades, but this is not indicative of future returns, certainly not. The next consideration is that, as I said earlier, Philippine financial markets are immature. It's young and it is immature. It is not an efficient market. And because of that, there's a lot of opportunity to take advantage of mega trends and market anomalies, specifically historical patterns. Our advice to everyone, whether you are a novice or if you have experience in the market, is that it's great if you would take a long-term view. So you should invest at least part of your portfolio in firms that will benefit from the country's demographic window, or demographic dividend, as some would call it. Our recommendation also is to use our dog strategy to anchor your portfolio. What we mean by anchoring your portfolio is that by using our dog strategy, you will lessen the volatility of your the volatility of the returns of your portfolio if you use our dog strategy. Also, because of the upcoming election window that I talked about, the time to be defensive in this market is nearly over. Lastly, but to mitigate risk, there's always risk now. There's no assurance of that we are correct 100% of the time. We certainly make mistakes as well. So to mitigate risk, our advice is to reduce exposure to companies that will be negatively affected by megatrends. And of course, lastly, just to plug in our online platform, I hope you sign up with MyTrade for unique and actionable trading ideas, some of which I have shared with you today. So that is the end of presentation.